welcome to episode 2 of Financial Freedom Assets Under Management with your host, Gabe and Misha Kaufman. We're super excited to get into this. So excited that it's 10 o'clock on a Monday, and we just wanted to make sure that we delivered this for you. Before we start, Gabe, how are you doing?
10 out of 10. This is my second podcast in the day. Got to go visit a buddy's podcast down in Fort Refresh to see his whole setup. And we've talked to 5 brokers today. So we're clearly in the hunt, looking for some new product and some new opportunities. And then, of course, between the two of us, we spend a lot of time focused on our most recent acquisition, trying to get things lined up. So, yeah, things are exactly where we want to be. Plus, there's an event that I love. It's coming up. It's an annual event related to learning how to invest departments. It's happening here in Dallas at the end of the week. So, very excited about that. You can see all my friends that fly into town for these big events.
That's awesome. So we're on the ground. We're making it happen. So I've been at our property pretty much all day, just making sure everything is lined up the way it needs to be. And it's a great way to start the week. Monday morning, just kind of hit the ground running. Today's topic is really important to us. So it's really talking through the tools to build your ladder for financial freedom. I know there's tools that I use very specifically that help me. But Gabe, before I kind of talk through my items, what do you use for your tools?
For gauging my plan and building my plan, I think it's pretty much down to the basics. There's 3 things that I try to focus on when thinking through, building out my financial freedom plan. The first tool, I don't want to say here, this is the facts, is the budget, right? So I'm at a stage in life where I have to make said with a significant other, and we have to get on the same page about how we're going to have a best fit approach. So neither the two of us nor I are much of somebody like the type to sit down every day and review our budget in great detail, but we do like to have some rules of thumb and some strategies that we found that helped us are sort of what we talk through, and then we put those strategies in play with like some high level numbers associated with buckets each month. Whereas my older brother is very much so automating everything. He's in from the pay it first camp, so like out of his paycheck, things going to like 6 different bank accounts, and he can only spend a certain amount. He sets limits on himself, and then he categories it as life hates it, and the two of them bear through it. But also, they have an amazing savings ratio, and I think for me, the biggest part of budgeting is really figuring out what my goal for a savings ratio is. So that's my tool number 1. So number 2 is always thinking about what my plan of building a parachute is when I had my W-2 job. Like, what is the end goal with my W-2 job? At most points during these financial freedom journeys, we're working for somebody else or we're working for ourselves, right? And in either one of those avenues, really thinking about what's the exit plan and what point am I going to be able to sort of focus on my entrepreneurship first and foremost. Because I think that's an excellent path forward. Not everybody will. Some people will choose to be W-2 employees for life and build their plan by investing in things that they don't have to spend their time on. And that's great. But I always start trying to think about what's my end game, what's my exit plan for my job, so that I can amplify. I know what plan will I be able to amplify, making more money, right, than my job possibly could. Side hustles to become my main hustles. My real estate investing becomes my actual career and develop my small business. But I'm interested in other types of businesses, and that's what we're going to focus on. It's really thinking about the exit there. And then the third piece is about my investment. And the investments are critical. And then investments need to follow suit behind those first 2 things. Like, what am I doing every day? Like, how much can I actually save and put into stuff? And then what am I doing every day on my job? And how can I like balance that out with my investments, which will grow slowly over time. But you can't do anything with your money if you don't put it to work. And so I think that's where having people in my circle with experience on how to invest was the way I got better at investing, and hopefully, all this is gems for you today, because I think I'm never going to stop learning about investing.
Never.
Right now, I know about real estate investing, and that's what we're going to try to share more about from the investing side of things, but there's a ton of different ways to invest. And I think that I'm still in learning mode for many of the other buckets.
Yeah. And I think we always got to be in learning mode. I think the second we're not learning, things will go downhill really quickly. This second episode was supposed to be really more like tools and strategies. So I did want to kind of go a little bit more concrete than I normally would. One tool that worked really well for me is actually cash flow. I think it's called cash flow quadrant. Cash flow with Rich Dad Poor Dad. So literally, I'll go on Rich Dad Poor Dad. They have an online cash flow game, and I used to just play it all the time and just learn. Okay, I don't know what this word means. Let me research and read a book on it. I don't know what this means. Research and all those different parts so that I'm playing the game and I'm learning the terms, the concepts. I would recommend that you all play that game, Cash Flow by Rich Dad Poor Dad. If you don't have a group of friends with you, I've never played the board game. I just played the online game. But it has been crucial for me in kind of developing my skill set and learning what assets, I need to learn more about to kind of hone in my strategy. The other is you need to be able to know where you are as of today. What's your net worth? How much income you got coming in? How much expenses you got coming in? And I think you can do that a lot of different ways. Some people have, their balance sheet, their income statement, their cash flow statement. Some people write it down. I created an Excel sheet. I'm actually going to share it to give you just a sense of what you can do. By no means do you have to do this, but it's good for you to have something to really map out what they look like. So, Gabe, let me know when you can see my screen.
I can see your screen.
Can you see my screen? Okay.
Yeah, I can see
So
your
this
framework.
This is an example of what I have done, and it's been built over time. So nothing was started from day one. In column D and E is where kind of I anticipate what my salary is and my wife's salary, not including bonuses. Then we anticipate, therefore, what our monthly income is going to be before taxes. I break out what are going to be our main expense categories for a given month, with taxes, what that is, without taxes, projecting what that is for the year. And from there, we can really start to tackle and this is just me, this is not for everyone, right? But for me, this is a great way of seeing, okay, on the tax line, what can I do to offset it? Okay, well, if I'm investing in real estate, I can invest some of this, or I can offset some of the taxes. So I'm going to get money back each year. There's a child tax credit, and whatever I'm reading or learning that applies, I'll add it into this kind of category. Over here, those are my expenses, and then I kind of budget. I think like Gabe talked about, so you want to have a percentage that you have to invest a month. I budgeted for somewhere between 11 and 14% that I can invest in assets. And then these are kind of the different assets that I chart out, what I anticipate the return being, what the exit strategy is. There's just something that I have in front of me at all times to be able to track and just kind of know where I'm at and where I'm heading at a given period. And this started very small and it grows over time. I have different allocation strategies. So if I want to go into, I have a small stock portfolio, I can kind of look to see which ones that I have allocated and what percentages, what stocks I have in Robinhood, what kind of crypto I have at any given time. But I also used Dave Ramsey's financial calculator. So Dave Ramsey has a great financial calculator where you can just input the numbers of, hey, if I invest X amount per month, when will I be a millionaire? When can I retire? I made my own projections based off of cash flow, but then I also have a Dave Ramsey projection of when I would retire or when I would reach a millionaire status. So those are kind of the tools that I've used and built over time that works for me. It doesn't work for everyone, but it helps me understand kind of where things are. And then I use a couple different ratios. So I'll kind of track where I'm at with credit cards or bills coming up for the upcoming month at a given time, how much cash I currently have, how much is going to come in at the end of the month, and kind of what are the future revenues that are coming up, future expenses. And then here's where I'll put in whatever kind of current deals that I'm looking at just to have it in front of you. But then we also kind of want to move to the future. So, where do I anticipate being 10 years from now? If I'm on this pace, adding a certain amount of properties at a certain income, this is where I should be at. And though some of these things have changed, we got a baby on the way, so we got to prepare for baby expenses. Me and my wife, we got to plan some stuff together. So I got that. But I also have a sheet for different credit cards. Which ones have the particular bonuses that are gonna allow me to get some cash back for free, and who has good bonus options, or Southwest Airlines, all those things. I try to chart those all in one place and just kind of add to it over time. It's a working document that I use, but that's just an example of what can happen just by tracking where you are. You can really start to maneuver and position yourself in ways that will allow you to kind of achieve the goals that you're looking for. Let me stop sharing. Gabe, did you want to kind of take the lead from there?
No, I'm very impressed at your diligence there. You could probably teach a master class in it, and this is a good intro. But I think this will be all the more reason for people to kind of follow up with you after listening to this if they really want to take a deeper dive into how you've managed to track. Again, starting from a very modest income, the fact that you started from a teacher salary and began practicing what you're preaching now, and were able to get where you're at in terms of your 7-figure net worth. It's really fun to watch. It's been really cool to see. I am going to only add to what you put up there a moment ago. I think one of the major categories, we've all been trained well in terms of investing into the stock market. And my big takeaway from the stock market, if I'm going to go down that particular bucket, and I might cover off on a couple buckets before we end the podcast.
Yeah, you're good.
The stock market bucket, I think the thing that makes the most sense after I've looked high and low and left and right is, unless you're going to become a day trader or an options trader or spend a full day's worth of work getting an edge, I think you should stick to some of the better, like Vanguard Total Stock Index, and the funds that have extremely low expense ratios, extremely low. They're basically free to utilize, and they track large indexes, and you just sort of set it and forget it and start to turn that into a true asset. It's much easier to watch your growth. One of the things I learned about the stock market is, especially if you're trying to play the high-low game and trade on individual stocks, or the Magnificent Four or the Magnificent Three, because of the volatility, the way the returns function is, if you have, let's say you have a bunch of years of balancing between 10% return and 6% return, like it's 10 and then it's 6, it's 10 and then it's 6. That does not mean you're going to have an average of 8% return in the stock market, just due to the way that the trading will swing really far down and then really far up, and the values will swing really far down and really far up. The return rates you're going to get by messing around with individual stocks is actually going to be dragged down by the volatility, and you're really not going to see that magic number we all want to see of 9% pre-tax, maybe 6 or 7% post-tax, which still isn't very remarkable when you include 3% inflation. We really want to start to see those double-digit returns to kind of outpace normal, but you should have some normal in your profile of assets you're investing in. This is about managing lots of different types of assets, and I think our podcast is really going to focus around real estate because it's more complex and there's some learning there, and it's what we know. But I don't think you need to be doing anything too fancy on the stock market side of it. Just invest in, either a mix of like international, regular, like S&P 500 or total market, Vanguard type of things. You can do emerging markets a little bit if you want to. You could do some bonds, but actually, I've heard annuities are a better replacement for bonds. It's something people can look into to balance out. And I think they're just there for when the stock market goes way, way down. If you got 10 or 12% in bonds, you're always going to have something you can liquidate without feeling like you're hemorrhaging your stock portfolio by liquidating anything when everything's really low. But there's a lot of different ways to kind of go down the fairway. when you're talking about stock investing, I prefer to just set it and forget it with these really low cost funds that people can kind of buy into. Like Vanguard has a really good one, and that's probably the one I'm most familiar with. And my older brother created like a little 2-pager. So if you reach out to Misha and I and you connect, I'm happy to share that. And it's kind of a how to. It's literally like the links to the websites to go to, how much to put in each of them, and sort of how to get started. He created it for our sister who came into some decent money recently. And, it's been really helpful for her. She already made a ton of money just by following the simple steps. And again, it's not about how much you make in the short term, though, right? When you're investing in the stock market, it is a 20 or 30-year trajectory to really reap the full benefits and hit retirement. And that's one of the problems, right? Is that it's a lot slower when you've got that return metric of like, ooh, it's going really well if I played it right and I got a 9%. Now, what you definitely don't want to do, and this is only for most people, there's probably some exceptions to this, but you definitely don't want to be paying somebody to manage your funds and be a financial advisor that gets paid to make less than what those funds I just mentioned will make, right? Just go total stock market, make it simple, have a really low expense ratio. Whenever you bring in an advisor, their expense ratios, basically they're taking 1 or 2% away from your returns. And it's very rare that they beat the marketplace, especially with all the technology that's driving performance on. I think you're just much better off sort of sticking to the boring path of learning how to yourself get in there and get a diversified set of investments in what we would call like the highest performing, the strongest corporations in the country, the 500 or so of the strongest corporations in the country. So I think it's really easy to do nowadays, and highly recommend.
But it depends. I will push back a little bit. It depends on people's personalities, right? So like, you're right. The safest thing, like if you are a safe investor and you're really just thinking about, I want to make sure in the long run where I need to be. When it comes to the stock market, you're going to do dollar cost averaging, which means you're going to put the same amount on a set schedule every week, every couple of weeks, and then you set it and forget it, right? So that works on the like rational level, right? But there are people that play the stock market or that are in this game that like want to have a little bit of fun, right? And in that case, you need to take, or not you need to, you need to be comfortable with the amount of money that you're okay losing, right? So not amount that's like future goals, but the amount that you're okay losing, then go ahead and invest in a couple stocks here and there. Just don't anticipate kind of those major returns. And you're talking to a person that's made that transition. So I started mostly like really heavily thinking about stocks and the stock market and then transitioning into real estate. But I still make plays in the stock market, but it's very different than what it used to be. So for example, I just read a book recently. I don't remember the name of it, but he talked about there's people in their portfolio that have just 2 stocks in their portfolio, right? Rather than going for the diversified approach, they choose 2 stocks that they know really, really well and that they feel comfortable hitting on the long run, so that you don't get those opportunities often where a price is mismatched and you know it. But if you can take advantage of it in those moments, you can make a lot of money. So I've made 2 major stock purchases in the last couple of years. One, I bought Exxon about 2 months into the pandemic because oil prices just shot down. And it was just very obvious to me that they're going to come up at a later time. So I bought big and it made a lot of money, right? Same thing, Amazon a couple of years ago, for whatever reason, some news came out that has no effect on the future projection. And then there's a moment where it came down. I was actually like on a plane ready to go somewhere. And I looked at the price. And I was like, no, I need to buy as much of this as possible. And I bet big. I put, more than $10,000 into it. But I knew where it was at, and I knew that it wasn't going to go much lower because it was underpriced, and it doubled in value, in about a year. But those are plays that I make knowing that they're strategic, but there's not, you can't hit those home runs every single year, right? Even your great investors, your Warren Buffetts, those people, they wait for the fat pitch that they understand, they know the dynamics for, and then they hit it, right? But what we want to do as real estate investors, you have much more control over the process. You don't have you understand kind of market dynamics and fundamentals, but it's very easy for you to analyze whether or not something is underpriced, and you have much more control over the returns you're going to have, so that you have less risk moving forward. And that's kind of what we, as in our smart lives, right? We want to just minimize risk and make sure that we reach the financial goals we have. But every one of us has that little part of us that just needs to bet a little bit or have a little bit of fun. And that I would invest or put some money into doing that, because if you don't do that, like if you don't eat a little bit of chocolate cake on the side, then you're liable to mess up your whole diet. So that's my 2 cents on that subject.
That's fair. I've got a couple of things that I will briefly cover. One, it's a really good book on stock investing. There's some other strategies and other times in people's life, right, where they're really going for more of a cash flow play and they're living off of these investments. And it's got some good tips and tricks for how to kind of focus on those dividend stocks and those stocks that kind of perform and balance out of your portfolio according to where you're at in life. So there's that piece. Second piece I'll say about eating chocolate cake is don't become addicted to eating chocolate cake. So just so we're clear, just so that I can give some experience here, between the years of 2001 and 2006, I watched my father go from not knowing a whole lot about stocks to becoming one of the most savvy stock investors that I've ever met. He did extremely well on his portfolio. And then we all kind of know what happened in 2007 and 8. And so kind of the point being, as Misha first said, be prepared to lose it all if you're going to be a super active stock investor. And although
you can't be super active. The opportunities that are going to come up are going to be very small in a very short window of time. But when you recognize those, you can take advantage of them. And just Gabe, as an aside, I think so. I showed my financial information a little bit earlier. If you look at the numbers, 87% of my portfolio is in real estate, right? The very small part is in crypto and stocks, but those, because it's so weighted in real estate that I feel confident I know where it's going to land, I'm able to take a lot more risk with potential higher upside because it's not my whole portfolio. It's a small amount that if it hits big, great. If it doesn't, not the end of the world.
And
so you always
you're
kind
going
of
to actually have that problem, just being a syndicator, being an asset manager, where majority of your stocks, or sorry, majority of your interests are always going to be in real estate. I've been trying to track some intelligent folks on that side of it in terms of the like the doctor community, and one of the leaders in that space that kind of does a lot of financial advice, his portfolio he showed us, and I was pretty excited about it. I think it's actually a good place to aim to get to, which is a little bit more heavily balanced on the stocks and equities and bond side. I said stocks and equities, but equities and bond side of like 60%, and then 10% just all very alternative things, and then 30% real estate businesses. And honestly, that's where I kind of want to get to when I'm in my old age. I don't know what the number's going to be. And my number's going to be a really large number because of real estate, because I've gotten to this place where I went from being an investor in single family stuff to being really active and like finding deals and making magic happen by solving problems more in like a business strategy style way in single family. And then we've mimicked that at scale in multifamily. And now we're in a really good position. Naturally, that'll lead to having way too much as far as like an allocation perspective in real estate. So as we get towards that tapered end of our activity in our business, we're gonna have to tuck aside items into what I would call more our passive portfolio. And within the passive portfolio, I like 60-30-10. I think it's a really good split. I love equities as long as they're sort of spread out across the stock market, because it doesn't matter if oil does well and Exxon is crushing it. Doesn't matter if tech falls off the map. I've got this broad spectrum of amazing, successful businesses that have managed to list and report back to their sort of third-party audits and the investment community every quarter. And it's a comfortable space. So I have no qualms about saying that the stock market is a great place to maintain wealth. I just think that with what I've seen recently, businesses and particularly real estate businesses are an amazing place to grow wealth quickly because of the leverage and sort of demand in the space. So, but I think we did ourselves justice, right? Because although most of what we'll talk about, I know what next episode is going to be sort of an offshoot into values, but we get into the season, we're going to be focused on real estate and particularly multifamily real estate. And I believe it's important to start to talk to people about passively investing in things. You do have to acknowledge that there's a lot of options out there for where to place money, and that it is not normal to have 100% of your retirement completely deployed into multifamily. If it becomes normal for you and you're passive on those deals, I would actually second guess that approach. And unless you have an insider's knowledge, like we're talking about having even in the stock market, right? Unless you have insider knowledge on your real estate, I think it's important to consider having money elsewhere. And diversification is good for keeping wealth.
Yeah, I think that's a great point. I'm trying to just think through strategies, right? Because we're talking to people that may have their money in all types of different things. So, like, one thing to think about is whether you're investing in a business or a syndication or anything, you're essentially investing in a group of people, right? So, making sure you are investing with people you trust, people that you respect, people that you know are knowledgeable that are going to do right with your money is really important. Even if that's a corporation, like you got to vet those people, feel comfortable that they have a strategy that's going to work long term, that they're doing a good job of their asset allocation. So don't get so caught up in the name or the brand. Really think through the people that are there. So that's one thing that I would highly recommend. The second thing, which we've already talked about, is it's really about mitigating your risk, right? So making sure you do everything on the front end to not lose money. Even if you are a stock picker, right? We're talking about me, but like if you do something where you're getting a 30% return, 30% return, 30% return, and then 1 year you get a minus 300% return, your compounding is done. You got to start all the way from scratch. You need to be in something that's going to be consistently growing over time, even if it's less, if it's a less percentage. If you're not going to lose money over time, then you're going to win. So those are the two things. You never want to stop the compounding, and you're investing in people at the end of the day, unless you're investing in crypto. And if you are, God help you. But that's
Two
kind of
more tips,
my
then
2 cents on those subjects.
I'll can it. First tip.
Yeah.
Well, you want to invest as much of the money you make as possible. So active tax planning, being proactive and learning tips around how to save on taxes, how to do what the IRS wants you to do so that you have more money to invest cannot be more critical and paramount, especially right now as things are dynamic and shifting in terms of the IRS landscape. I was reading something the other day that was kind of putting some more ammunition in my real estate tank in terms of investing and getting people to consider investing in real estate. It was around the tax benefits associated with it as a whole. Like almost everything you learn about real estate as you start investing in it, the things you didn't know, when you learn new information, it gets better. Like, oh, I was investing in this single family, but actually I can write off this, or I can now claim this as another deduction, or I can transition things over here and make even more of a benefit for myself on the taxes side. Very little else where you learn more about it, it like gets better for you. You learn about your IRA that you had, or sorry, your 401k you had at work, and then you read the fine print and you're like, oh, I've been getting charged these extra fees this whole time. Or you're in crypto because it's the best thing ever and it's performing extremely well. And then one day you go in to convert your personal person coin, snowflake coin, we'll call it, into back to Bitcoin, and you find out it doesn't exist because it's completely gone. And the next thing you know, you're chatting with the FBI trying to trace down your money. So you really have this special category that I've loved to learn more about, because as you learn more about it, it gets more beneficial. I feel like it's a compounding effect in terms of the knowledge that you gain in the space, and that can't be said in a lot of other avenues. No matter what, no matter how much you learn about the stock market, you're still taking on an exorbitant amount of risk when you're doing more frequent trading. And in real estate, just the more you learn, the better and safer your investments are going to be. And then the second piece is to find money that you didn't know you could invest. And I mentioned a moment ago about 401ks at your job, because for about a year and a half in the beginning of my real estate journey, I had forgotten about and not realized that I had a giant chunk of money from a former employer, because I just assumed there was nothing I could do with it. And at a real estate conference, I learned about self-directed investment IRAs, investment retirement accounts. I don't know if I got that right. Self-directed IRAs. And I transitioned my 401k into a self-directed IRA and was able to make some pretty substantial investments and direct them myself, instead of leaving the money over here in the 401k where it had a 2.5% fee, and it was stuck in a mutual fund that had, at the time, 3 or 4% returns over a 4-year period. It was so much better to move it into investments, and it also gave me a lot of fodder, because I kind of felt like I found free money to play with, and I couldn't put them in my own deals, so it allowed me to sort of try out investing in some commercial real estate options that I wasn't running, and it was great.